Hi, I'm Jason Ball, and this is Jason FinTips. Thank you guys for joining us. Today, we're going to talk about what a weak dollar means for your retirement plan. But before we get started, we just have to do a quick disclosure before we get through everything here. The content shared during this video is provided for general education and entertainment purposes only. It is not financial, investment, tax, legal, insurance, political, or medical advice. No personal recommendations are being made. Nothing presented here should be interpreted as a solicitation, endorsement, or guarantee of results. Although I do hold the CFP, ChFC, and CLU designations, I'm not acting as a financial advisor, fiduciary, tax professional, or legal representative through this platform. All examples, case studies, and scenarios are hypothetical and intended to illustrate financial principles only. Viewing or engaging in this video does not create an advisor-client, fiduciary, planner-client, insurance-client relationship. Always consult your own licensed professional for advice specific to your individual circumstances. For a full legal circumstance disclaimer, see jasonfintips.com/legal. And with that, let's dive into what a weak dollar means for your retirement plan. I've heard a lot of people talk about, strong dollar, that's out in the woods. Oh, the U.S. needs to have a strong dollar. But what is actually, I thought we'd take a look at today of what a weak dollar actually means for a retirement plan. So key takeaways, if you need to just get a quick little thing and get out of here. Basically, a weak dollar raises inflation and reduces your retirees' purchasing power. Export-heavy stocks and international investments may benefit, but fixed income retirees may actually feel a squeeze. Social Security COLAs might help, but it may not be enough to win in this type of environment. So protect yourself with diversification, inflation-protected assets, and flexible withdrawal strategies. And with that, let's dive into the weeds. When people think about retirement planning, they often focus on market returns, Social Security, and how much they saved. But there's another factor that can quietly reshape your retirement lifestyle: the strength of the US dollar. Even people talk about inflation, but this is a little bit different. This is another factor in there. How much of a foreign good can that dollar buy? A weak dollar may sound like an abstract concept reserved for economists and Wall Street traders, but it has very real effects on and implications for retirees. From the prices of groceries and healthcare to the performance of your investments, a shift in the dollar's value can ripple through your entire financial life. Let's explore the weak dollar affecting retirement planning and steps that you can take to help mitigate and protect yourself in the future. First of all, let's understand what exactly a weak dollar is. A weak dollar means the US currency buys fewer goods and services abroad compared to foreign currencies. Put simply, $1 has less purchasing power when exchanged for euros, yens, pounds. A strong dollar, so if you have a strong dollar, vacations in Europe would feel cheaper because your money would actually stretch further. A weak dollar, that same trip would feel like it becomes way more expensive because imported goods would cost more and it would be more expensive in US dollar terms. Historically, the US dollar has gone through cycles of strengthening and weaknesses. For example, in the 1970s, we saw a weak dollar alongside high inflation. In the early 2000s, the dollar decline boosted commodity prices and international investments. For retirees and any investor, these cycles can directly influence the purchasing power, investment income, and quality of life. If you're traveling abroad, a strong dollar would make it cheaper to go travel abroad. A weak dollar would make everything more expensive. Imported goods would have lower cost. If we have a very strong dollar, foreign goods are very cheap to import: TVs, cell phones, tablets. If we have a weak dollar, those goods manufactured in other countries actually going to end up feeling like they actually cost more in real dollar terms. Gas and energy, in a strong dollar, we would see stable or lower prices. And if we have a weak dollar, we might actually see rising oil prices, and oil imports cost more. So if the dollar would be weaker, the gas and oil imports would feel like they cost more. Healthcare, medical devices and if we have a strong dollar, medical devices and drugs that were manufactured in other countries would feel cheaper. But if we have a weak dollar, they would have a higher cost, and so they might be more expensive. In groceries, one thing we see is going on in the trade markets. Groceries, a strong dollar would see more stable, probably lower food costs for imported goods. But if we see a weak dollar effect, our higher, especially imported foods, would be considered more expensive. Weak dollar and inflation. A weak dollar often fuels inflation, particularly in categories tied to imports. Imported goods, it would be electronics, oils, cars, TVs, cell phones, laptops, anything that's not manufactured in the United States. The goods and services in foreign manufactured cars. When the dollar loses ground, we also have healthcare costs. Many drugs and medical supplies are imported, leading to higher medical expenses. Daily living, gas prices, grocery bills, and utilities often climb in inflation. If your monthly retirement budget is, like, say, $5,000, and inflation from a weak dollar adjusts 3%, adds 3% more to your cost, you're going to need about another $150 a month to maintain the same overall living standard that you had before they had a weak dollar in inflation. Over a decade, the difference compounds into tens of thousands of dollars in purchasing power. Now, this is a big one for retirees that are on a fixed income. We still get our COLA, but that does not affect that COLA is the cost of living. The thing's going up, but this is actually from the weak dollar has the currency exchange rate, which can cause goods and services to go up even faster. And Social Security, yes, but COLA may lag. The cost of you won't actually get the cost of living adjustment because it's a backward looking COLA adjustment. It's like what the cost of the basket of goods happens in the last 12 months. So a weak dollar has like a moderate risk. If you're on a fixed pension, so someone takes what's called the single premium immediate annuity, SPIA, it's not inflation adjusted. There's no COLA. A weak dollar has a high risk because now you're going to slowly see inflationary goods of goods produced outside the United States starting to cost more. A fixed annuity, same thing with a fixed pension and fixed annuity. They're just simply a pence payment. Rental income, rents may rise adjusted for inflation. Partial rents may rise. And with a weak dollar, rental income kind of moderate. Portfolio withdrawals. This is kind of something where adjusted for inflation. Portfolio withdrawals flexible, but it depends on the investments and how you're invested in your strategies. So that really can vary, and that depends on what your individual retirement looks like. How a weak dollar affects your retirement investment. So we'll kind of take a look at each of the different slivers of a portfolio. Export-driven companies like manufacturing, agriculture, and some tech firms benefit from a weak dollar because their goods become cheaper abroad. Import-heavy companies face higher costs and shrinking margins. For bonds, rising inflation rate erodes the real return on fixed income bonds. Treasury inflated protection securities and I bonds can help counter this risk. International investments. A weak dollar boosts the value of foreign investments when converted back into US dollars. International and mutual funds or ETFs may actually become more valuable as the dollar depreciates. Commodities and gold. Oil, gold, and real estate are often rise in dollar terms during weakness and tend to fare better during dollar downturns. Winners and losers in retirement portfolios when the dollar weakens. Asset classes, we would take a look at like U.S. exporting companies. They're going to probably benefit for cheaper goods abroad. So their dollars, people in another country are going to be able to purchase U.S. dollar goods and services are going to be cheaper in comparison. So their stock value may rise. U.S. import heavy companies, they're going to hurt for higher input costs. Their stock value may go down. Bond a traditional bond, negative because they have an impact of a weak dollar. It's going to be negative because of an inflation risk. Retirement, there's going to be lower the rate of return may return, but the real rate of return of purchasing power may actually go down. Tips, positive inflation protection security, they help preserve purchasing power. International stocks and bonds, they might actually see the impact of a weak dollar as positive because they're going to see gains when converted to USD. Retirement income sources under pressure. Not all retirement incomes adjust easily when the dollar weakens. Social Security, adjusted for inflation through cost of living adjustment and COLAs, but the COLAs do not always keep pace with real inflation. Pension and annuities, fixed payments lose their purchasing power as the costs rise. So a COLA-linked pensions are going to fare better, but if it doesn't have a cost of living adjustment in a COLA like a SPIA, it's going to end up seeing a greater loss in its purchasing power during this type of period. Requirement minimum distributions, higher expenses may force larger withdrawals, increasing the risk on portfolio depreciation. And this is simply saying that, you know what, the cost of imported goods have gone up, inflation's gone up, I only have this size of my retirement pie, and all of a sudden I'm going to have to start spending it down faster than what I thought, or I'm going to have to reduce my withdrawal rates in order, because I now have to go in and recast my numbers to see what my portfolio and what my retirement distribution strategy is going to look like. And maybe I'm not in the same position I was 12 months ago. This is why an annual review with the retirement planner who has retirement planning software to do cash flow planning on this is a great time to go make sure to follow up with this annually on your retirement plan. Um, Part-time income, someone might have to sit there and say supplement work might not fully cover the gap as expenses rise faster. Dollar implications of a weak dollar, lifestyle implications of a weak dollar. Dollar weakness isn't just about numbers, it impacts everyday choices from travel abroad, trips to Europe, Asia, Latin America. When the dollar weakens, are going to be more expensive. It's going to make someone who said, you know what, I'm going to have a very strong US dollar in a portfolio and I'm going to go live abroad. All of a sudden, living overseas becomes far more expensive if your retirement income is tied to the US dollar. Housing, healthcare, imported building materials, and medical devices can add pressure. Everyday life, prescription drugs, gas, and even groceries may rise notably for anything that's not produced inside the United States, but we also have inflation in there. So, what are some strategies you can do to help protect yourself in retirement? You can't, even though these are things that are beyond your control, inflation, currency risk, these are things that are outside of your ability to control. But what we can do is how to react to them. So, when the dollar weakens, um, when the dollar weakens and inflation rises, you might be able to safeguard some of your savings. That's something that might be in there, having a sliver of a portfolio and something like treasure inflation portfolios protection security is what a hypothetical retiree might look into. Government bonds that automatically adjust with inflation. If inflation is 5%, your principal grows 5%, ensuring your real purchasing power is preserved. I bonds or saving bonds that combine a fixed rate with an inflation adjustment. These have been popular for retirees because they're safe, tax deferred, and currently offer attractive rates. We've got inflation linked annuities. Unlike a traditional fixed annuity or a SPIA, these increase the payout as the inflation rises, keeping your income more stable in real terms. Real assets, real estate, commodities, infrastructure investments tend to rise in value when inflation is high, and they sort of act as a hedge against currency weakness. Example: a retiree with 20% of their bond portfolios in TIPS and I bonds may maintain more purchasing power over a decade of a weak dollar weakness than someone who only has traditional bonds. And you need to go and need to model this out. And I don't know, in fact, I don't know if a lot of retirement planning software right now takes into account currency risk. Anyway, that might be something to talk with your retirement planner that you're talking about. Diversify globally. I'm not. I know how. I know how it goes in there, but I don't think it's modeled on some of the current software. And diversify globally, a weak dollar boosts the value of the international investment when it's converted back to U.S. dollars. This acts as a natural hedge against domestic inflation. International stocks and ETFs. Companies abroad earn profits in stronger currency, which becomes more valuable in terms of dollar terms. Foreign bonds can provide steady income in other currencies, though exchange rate risk needs managing. Global diversification. Spreading investments across regions reduces reliance on the U.S. economy alone. During past periods of US dollar weakness, investors holding European and emerging market funds often saw stronger returns compared to their domestic only portfolios. Some reviews and strengths of your income sources. Not all retirement income is created equal. Some adjusted for inflation while others don't. Pensions with cost of living adjustments. If you have a pension with a COLA, check whether it offers, if you have a pension, check whether it offers a cost of living adjustment. If not, factor the inflation risk into your planning. Annuities with inflation riders or an annuity without inflation. These products with inflation riders, these products increase payout rates annually based on inflation, but worth considering in the upfront cost if but the upfront cost is higher. Rental income. Real estate rents often rise with inflation, making them helpful buffers against dollar weaknesses. So create a retirement income map showing which of your income sources adjusted for inflation and which don't, and kind of highlight some of the areas you may need to hedge against. So you also need to go into a start withdrawal planning. Um, How you take money from your retirement accounts matters a lot when inflation spikes. Adjusting withdrawals in high inflation years, cutting back slightly on discretionary spending like traveling or entertainment can prevent long-term depletions of your savings. Dynamic withdrawal strategies, rather than just sticking with like a 4% every year, consider flexible models such as guardrails approach that adjust withdrawals based on portfolio performance and inflation trends. We've also got the thing where you've seen like a bucket strategy, which is simply just carrying 2 to 3 years of a cash and short-term bonds for spending while longer-term money stays invested in growth assets. The cushions you're selling your during bond. And one of the ways I like to think about it is it's still a portfolio, a standard pie portfolio. The bucket strategy is just another way of thinking about a cash portion of that portfolio. So it really matters how much cash you need to be part of your portfolio when I would look at that as it's still a bucket, and what is still the overall asset allocation that someone is looking at from a top level view. Um, Tax planning for flexibility. Taxes can amplify inflation if withdrawals push into higher brackets. Strategic tax planning creates breathing room. This may be some Roth conversions, moving money from traditional areas to Roth accounts, means that withdrawing in the future are tax free, giving you more flexibility as expenses rise. Tax efficient withdrawals. Taking a look at the sequence of withdrawals of taxable, tax deferred, and tax free in a way that minimizes your lifetime taxes. And harvesting opportunities in volatile markets, tax loss harvesting can free up cash without additional tax burden. A retiree with both Roth and traditional accounts can choose whether to withdraw from each year, and it gives them a little bit of flexibility in adapting to inflation and market shifts more smoothly. Bottom line, protecting retirement from a weak dollar comes down to preparation. By combining inflation protected assets, and this is one of the things I think of is having a retirement withdrawal plan strategy. By combining inflation protected assets, global diversification, income reviews, flexible withdrawals, and a smart tax planning strategy, you give yourself the ability to adapt rather than react when the currency shift occurs. Example scenarios. The, what a weak dollar might look like in retirement. A domestic only portfolio would say something was 70% US bonds and 30% US stocks. Um, with a weak dollar, inflation runs at 4% a year, a double norm 2%. Bonds lose real value because they fix payments don't keep up with the rising cost. Domestic companies that rely on imports, retailers, manufacturers see shrinking profit margins, pressuring stock returns. The real purchasing power, hypothetically, in this one, could drop by 25% in 10 years. What it feels like a real retiree living on about $60,000 now will need equivalent of about $90,000 to maintain the same standard of living. The fixed bond income hasn't grown and the U.S. portfolio hasn't provided enough of a cushion. Diversified portfolio with an inflation protection scenario. A portfolio of, let's just say, 50% US stocks, 30% bonds, and 20% inflation protected securities. International equities gain value and converted back to weaker US dollars. Inflation protected securities also automatically adjust with rising costs. Export oriented companies benefit from cheaper dollar bond. Real purchasing powers declined is limited to, let's just say, 10% over 10 years. And this is just a hypothetical example. So a retiree would still feel a pinch of higher living costs, but global investments with inflated inflation protected income help soften some of the blow. Instead of falling below by $28,000 a year, they only fall below by about $8,000 a year. So just kind of an idea. Neither of these, I think, are going to be in good situations long term for this individual. But a stable dollar, inflation rate of about 2%, annual budget needed after 10 about 73,000, extra cost over 10 years by 132,000. Under a weak dollar, annual inflation rate of about 4%, annual budget needed over 10 years about 88,000. There's about $288,000 needed extra over a decade. So lesson for retirees. Domestic only investors risk losing 1/4 of their purchasing power in a decade due to a weak dollar plus high inflation. Diversified investors lose far less thanks to global exposure and inflation lessened. The difference between these two approaches can be about $150,000 in extra cost over a 10-year time horizon. So this makes clear that maybe this is a global diversification and inflation protections aren't luxuries, they're necessities for retirees who want to keep their standard of living when the dollar weakens. This is where we look into making sure to run the numbers, have some portfolios, understand what you're looking at. And I actually might think this is using more of a fund that's a overall. I absolutely take a risk tolerance questionnaire and figure out and run the numbers if someone needs to leave. I usually like to stay a little bit harder to equities because I think they have a longer term growth horizon, depending on the interest rates of the bond funds. Conclusion: currency shifts may feel outside of your control, but the impact on retirement is very real. A weak dollar can erode purchasing power, increase expenses, and test your strength of your retirement plan. The key, once again, is preparation. Building inflation protection into your portfolio and your strategy, and diversifying globally, having a retirement income plan that's part of your financial plan, and understand what you're going to do to address some of these issues, and especially even the currency risk and how that might affect you. So make sure to go work with a certified financial planner, someone's a fiduciary to you. Review the portfolio. Make sure to do tax planning and looking at cash flow planning and taking a look at how the currency risks may affect your budgets. Stress test your portfolios under what would happen, and look at building a portfolio that may be able to be a little more inflation proof, and understand how the portfolio is put together. With a financial planner and investment advisor who really has the tools and the skill sets to know what they're doing, or someone that you trust that has the skills and the skill sets and licensing to work with you. Um, One thing I think that's kind of interesting, I do think we're seeing a little bit of stuff for a weak dollar. I know there's a lot of stuff where we want to have a strong dollar, but maybe if this is a situation that we're going to have to deal with, you make decisions based on the hand that you're dealt, and make a strategy with the plan with what the current market and economic environment that we are given. And so what we try to do is just kind of adapt to it. So leave some comments. Make sure to subscribe and like. Thank you very much, and have a great day.